All right. Well, we're at 5 minutes past when we're going to start. So, we've got a few people coming in. So I think we should get started. For those who don't know me, I'm Terrence Critchlow. I'm a real estate investor. I've got single family rentals. I'm a partner in about 8 syndications as a limited partner. And I've got a few other random deals that I'm involved with. I live in Hawaii, as you can tell from my horrible backdrop with the palm trees. I retired from my job at Amazon in June, and I am basically an advocate for people gaining financial freedom using passive income to break their paycheck dependencies. So if you're interested in that sort of stuff, follow me on LinkedIn if you don't already. The reason I'm organizing this tax seminar is Jim and his team have saved me a lot of money over the past couple of years, and I wanted to share his wisdom and the strategies that we've used with a broader audience. A disclaimer, this is not tax or legal advice. While Jim is a CPA, Jim is not your CPA and doesn't know your particular details and information. So if you want to get his actual advice and how it relates to you, I'll send out some contact information for him, or you can reach out to him on LinkedIn. But anything we discuss now is for pure informational purposes only. It is not to be considered tax or legal advice. I'm sure you've heard that disclaimer 1,000 times, but it needs to be given every time, particularly when you've got a CPA on the call. For those of you who have registered, I will also send out a recording of this call probably early next week, so you can review it and share it with your friends and sit down with your partners and get all the tax planning you need to do for the next few months taken care of. So with all that monologue started, the way this is going to work is I'm going to have a conversation with Jim about a bunch of different strategies that I've used or that I've considered using, and Jim and I have talked about, and we think may be generally interesting to a broader audience. At the end of that conversation, we should have about 15 minutes left for questions. So if you've got questions, please put them in the chat, and we will go from there. So with all that out of the way, Jim, do you want to introduce yourself?
Yeah, absolutely. So for those of you who I haven't met yet, I'm Jim Ross, CPA. I'm located in Mesa, Arizona, just outside of Phoenix, where it's been very, very hot this year, but we're finally seeing relief in the 70s this week. So we're feeling good finally. I am from Arizona, grew up here in Mesa, attended Arizona State University. So go Sun Devils, for better or for worse. I've been working in accounting, for about 17 years. Been with my current tax accounting firm called Provision PLC for the past 11 years, where I am a partner. Provision is a tax accounting firm that works primarily with entrepreneurs, but we define that sort of loosely. So we have, for example, entrepreneurs who their business is their lifeblood, and that's how they earn their living. But also in many cases, folks who their primary source of income is from working as an employee, where they receive a W-2, but then they have businesses on the side as well. We have a sort of gig economy, lots of side hustles going on out there. So folks have businesses on the side, lots of rental real estate investment, and various other types of real estate and other syndicated investments. We filed tax returns for many syndicated investments as well. Apartment complexes, self-storage, mobile homes, you name it, we do it. And so a lot of my time as a tax professional is actually spent working with the business owners and going through their portfolios, their business activities, their entity structures, what kinds of LLCs, trusts, partnerships, corps, et cetera, do they have or do they need? And just looking for ways to set them up a little bit better asset protection. We want to, of course, mitigate taxes where we can, what kinds of deductions can they apply for, what kinds of credits might work for them. Where are they heading with things as far as their financial goals go? Are they looking to get into something or start something? Very often, wisely so, people thinking I'm going to start doing rental properties, they come to us and say, well, what do I do? What LLCs do I need? And what deductions can I use? And what's a cost seg? And so we spend a lot of time going through those kinds of things with folks, but not everyone's, purely entrepreneurial. In some cases, folks just have a lot of investments of various types, or they're looking to do alternative investing, which would be, sort of outside of the typical Wall Street, ETFs and mutual funds and all of that, looking to do other types of investment, real estate being probably the biggest one, but of course, oil and gas and all sorts of other things can apply as well. So, we talk with them about what are the characteristics of investments, what do you want to get out of your investments? How do you rank investment preferences for you? What's number one? Is it tax benefits? Is it rate of return? Is it simplicity? Is it time commitment? Do you want something that's very hands-off, or are you willing to be a little bit involved? And so you have to kind of rank those preferences and say, all right, well, based on how you've said you view investments and what you want to get out of them, these are kinds of things that are going to work for you. And so we'll go through that with them and help. We're not investment advisors, so we don't pair people with specific investments, and we never say you should invest in X because we're tax accountants. That's not our job. But again, we talk through those characteristics and say, all right, well, based on this kind of investment and what you're wanting to get out of it, this should produce, what you're looking for it to produce. So if you're looking for an offset to your W-2 wage income, and you come to me and say, well, I'm going to invest in ATM machines, well, that's not usually going to work out in the way that you wanted it to. And so without getting into like particulars there, as Terrence alluded to, everyone's got a different set of circumstances going on in their tax picture. And so you have to sit down with a tax planner and say, okay, based on my actual context, what types of strategies make sense for me? Because it's not one size fits all. If you could go online and read a book or an article and do tax planning, and if it was that easy, everyone would do it, but it's really not. It has to be catered to the individual. And so that's what we spend our time doing. Of course, we do file the income tax returns. We do all sorts of filings, personal, S Corp, partnership, C Corp, trusts, gift taxes. If it's in the realm of income tax, it's in our realm. So we do hundreds and hundreds of filings every year as a firm. We have clients in all 50 states and in a number of other countries outside the United States. And so we get to see a little bit of everything. So I have the advantage in my position of kind of seeing what people are doing and what works and what doesn't work. And so if you're saying, I'm going to do X, I might say, well, okay, let's talk about what the potential pitfalls are with that. Or, yeah, no, that's great. And here's how it could work.
Excellent. Well, why don't we dive in with one of those strategies that I think most people have heard about, but most people can't directly, at least in this group, can't take advantage of, and that's real estate professional status. Do you want to give us a little bit of an overview of what that is and what would disqualify you from being able to do that?
Yeah, absolutely. Real estate professional status is a tremendous potential opportunity, but whether you can meet the criteria in your tax picture is, it's not the easiest thing to accomplish, and some folks can get there and some folks can't. The reason it's important, and it's very commonly known that real estate is this great tax advantaged asset. So you can go and buy rental properties of various types, single family, multiplex, commercial, etc. And there are ways to generate paper tax losses where I get to accelerate deductions on the cost of the property that I bought. And the result is very often, at least in the beginning phases, I have a big tax loss on paper. Doesn't mean I've lost money, just means that I get to write off a big piece of my purchase, and that tax loss might be able to offset other sources of income that I've got so that I'm paying less tax on that income. The challenge is in the tax code, you have categories of income. Okay. Namely, here, what we're talking about are the categories of active and passive. So your W-2 wage income is active income, and rental real estate is by default passive. We'll talk about some instances where it might be non-passive, but the default treatment is that it's passive. And so if you have a passive loss from real estate and you have active income from W-2, this loss is not going to negate the tax on this income. It's a different category. They don't get to mesh together and net out. And so what happens is, if you can't use that loss, you'll have a carryover loss, and maybe in future years you'll get to eat into that loss and use it. If there's passive income, you can offset passive against passive, right? So you might have a loss in year one that you didn't get to use because you didn't have any other sources of passive income, but later maybe the passive income comes along, and then you'll get to use that loss up, and you can carry that loss over indefinitely. But you'd love to use the loss now against your other sources of income. So how do I take the passive loss, this passive rental activity, and make it non-passive? Well, the first thing you can look at is real estate professional status, which has nothing to do with being a licensed realtor. Okay, you don't have to go to real estate school and take the tests and whatever and get licensed to and call yourself a realtor or anything like that. You don't have to go work for Keller Williams. It's based entirely on the time you spend on your real estate. And so if you're doing real estate professionally, you have to actually log and track your hours. So you're going to say, all right, well, I have this one property, or maybe I have several properties, but you keep a log of the time that you spend on all your real estate activities. And to meet the criteria of being a real estate professional in the tax law, you have to A, spend at least 750 hours in aggregate on all your real estate activities per year, 750 hours per year. And this is usually the harder one. You have to spend more time on real estate than you do on non-real estate. So if you work W-2 for Amazon or Apple or Google or whoever it may be, and you work 2,000 hours a year doing that, and then you work 750 hours a year on real estate, you haven't met the criteria. In fact, people who work W-2 jobs almost never qualify as real estate professionals. So that's what makes that one difficult. But again, going back to why you're trying to get there is if you could create a scenario where that activity was non-passive, okay, if you could have an active rental property business, then you could generate a tax loss and you could take it over against your W-2 income, and you could probably get a big refund of the withholdings that came out of your W-2 all year. So all year you're making wages, they're taking taxes out, and then along comes this tax loss at the end of the year because you're a real estate professional and you've invested in some real estate, and then you get a bunch of those withholdings back as a tax refund. And that would be a good outcome. Let's see. One other point to mention on real estate professional is that if you file a married filing joint tax return, either spouse can qualify as a real estate professional. So sometimes spouse A is the W-2 earner and spouse B doesn't have a job, and they could be a real estate professional. And if they generate tax losses, they are going to be allowed to use those tax losses to negate or offset the income from the other spouse's W-2 earnings. So that sometimes opens the door where one spouse is a W-2 earner and the other one's not. Comments, questions, Terrence?
So I think that's clear for me on real estate professional. One of the things you mentioned is that the losses will continue to accumulate over time if you're not in a real estate professional status. What happens when you sell the property?
Great question.
I got a rental and then I've accumulated a whole bunch of losses, then I sell it. How does that work?
Yeah, so a couple of different things outside of being real estate professional that would enable you to use those passive losses that were previously suspended. Okay. Number one, income arises within that passive category. So it could be you banked a loss in year one, year two, the circumstances are different. You've got just income. If the rental property is cash flowing well, and you've already kind of taken your big deduction in year one for depreciation, there may not be as many big deductions after that. So now there's positive income later, and I get to start using up that loss from the prior year. And so then I have tax-free cash flow for a while until I use up that loss that I originally started with. So that's one scenario, because you can offset passive with passive. Okay, future passive income and past unused losses, they can offset. The other one is if the activity Now, activity could be a rental property. It could be your interest in a partnership that owns something. Okay. You have to look at the activity and say, if that activity is disposed of in one way or another, okay, and usually it's a sale, right? You sold the property, or you owned a K1 interest in a partnership that owns an apartment complex in Austin, okay, and they sell the property. Well, now that activity for you is disposed of. It's no longer, relevant in your taxation. So any losses that came from that specific activity, if it's disposed of, get to be used up in that year that it was disposed. And so there are tax forms. There's what's called an 8582 to get, really fun with tax forms lingo, the 8582. And then there's usually some statements that kind of go along with that, and carryover statements that tell you by activity. If you have 20 rental properties that are all passive, you may have little bits of passive losses that are tied to each of those rentals that carry over from one year to the next. And you kind of use them up ratably in most cases, or if one of those properties sells, then its amount of loss is going to free up. It's going to get deducted in that year.
And that can go against your active income in that 1 year.
Yeah, it'll go against whatever you have for income from any source.
Awesome.
Okay. So it creates a little bit of a planning opportunity. A lot of folks don't know, where to even look for that on their tax filing. Of course, we go straight to the carryover forms a lot of times when it's like a new client. We're trying to figure out what's going on in their tax picture. We're going to look at that 8582. We're going to look at the carryover schedule. We're going to say, hey, man, you've banked $200,000 of passive losses over the last few years on these passive rentals you've been running. And you're talking about potentially selling one of these properties. Maybe you want to get cash out, or maybe you just want to redeploy that capital into a different asset for whatever reason, that you've targeted something else that you think is going to perform better. And you're talking about 1031 exchange. Everyone wants to talk about 1031 exchange. But if you have banked losses, you may not even need to do 1031 exchange. You might have a couple $100,000 of potential gain on the sale that you're trying to get out of with the 1031. But if you already have a couple $100,000 of passive losses sitting there carrying over from one year to the next, then we're going to identify that right out the gate and say, hey, man, let's not even do 1031, because that's a bunch of hoops to jump through and we'd rather avoid it. Right?
Yeah. No, that's awesome, because the 1031 can be very challenging given the tight timelines.
Yeah. Yeah. Very tight.
So
and no one wants their money to sit with an intermediary while they're trying to close on the next deal. That's not fun either.
Yeah. So you mentioned there's the active and the passive, and that the real estate is passive by default. So something that people talk a lot about, and I don't like the phrasing that they use. They talk about the short-term rental loophole. I think it's the short-term rental, code and the features that it's there, because it's not really a loophole. It is intentional, right? Hotels are not run as short-term businesses, and if you're doing a short-term rental, an actual short-term rental, you're effectively running a hotel. Might be a very, very small hotel, but you're effectively running a hotel. So can you talk a little bit about how that applies and what people might be wanting to look for there as far as?
Yeah, absolutely. So you kind of have to start by looking at, you touched exactly on the hotel scenario. On the one end, a hotel is plainly just a business, okay? And on the other hand is long-term rental. And that could be single family, or it could be apartments that are long-term rental apartments. And passive on one end, active on the other. Well, where does Airbnb or VRBO fall on the sliding scale? So the first thing you have to look at there is, what's the average rental stay? Okay. Some folks come stay 2 nights. Some folks stay a week. Some stay 10 days. Okay. And you have to look at that over the course of the year and say, on average, how long were the stays? Was it 4 nights? Was it 8 nights? 12 nights? And usually it's relatively short. Most Airbnb stays are like 2 to 4 nights. Okay. So if the average rental stay is 7 days or less, you don't really have a rental business anymore. That doesn't fall into the category of the default passive rental stuff. It becomes a non-passive business by default at that point. So the real estate professional criteria doesn't apply, because that's all about rental real estate. This is not rental real estate. This is business income. Okay. So then you have to say, all right, well, am I automatically active just because the average rental stays are 7 days or less? And the answer is no. You still have to have what's called material participation. Okay, this is true of any business. Okay, could be, your brother opened a restaurant and you're helping him get it up and going, and you have a little bit of participation there. How much is it? And we have to measure that to decide, are you active or passive in the business activity? Okay, so the criteria that we have to look at for material participation are not the same as the ones we just talked about for real estate professional. Okay, so the easy sort of low hanging criteria to be considered active in a business is if you spend 500 hours or more on the year in the activity, you're going to be active. Okay, so if you run a short-term rental and the average rental days are 7 or less, and you spend 500 hours a year on it, you are active in that business. And you could if there was a tax loss from that, you could use that tax loss to offset other active sources of income, because active and active, they can go together. Okay, so 7 days or less and 500 hours. And it's not important here to say I spend more time on real estate than my W-2 job. That criteria is out the window because it's not rental real estate, it's a business. Okay, so 500 hours is kind of the easy one. There's a few others, and it's sort of, when you're talking about material participation, it's, do any of these criteria apply? If any of them apply, you can be considered active. So the 500 hours is the one. If that one doesn't work, then we go to the next one on the list and say, can this apply? Do you do substantially all the work in the activity? So maybe I run a short-term rental and I don't hit 500 hours, but it's just me. There's not another manager involved or another owner that, we're sharing the workload with it. If it's next door and I'm doing all the work, I go and turn down the sheets and collect the payments, the maintenance, etc., then I have material participation, even if it's under 500 hours. So if you do substantially all the work, okay, let's cross that one off and say, okay, maybe I have someone managing it and helping me out, so I don't do all the work, but what else could I look at and see if I meet the criteria? Do you do more than 100 hours during the year on the activity and no one else does more? So in this scenario, there could be a couple of people involved, but if you spend 100 hours or more and more than anybody else that's involved, you've met the criteria, material participation. The last one, I think, is the easiest one to hit. So we're saving the best for last here. If you participate on a regular, continuous, and substantial basis during the year and more than 100 hours, you have material participation. So 100 hours over the course of the year is not a ton of time to spend. And as long as it's regular and continuous and substantial during the year, and that's maybe a little bit subjective if we're being honest, that's a criteria that you can look toward and say, all right, can I create this scenario where the short-term rental is non-passive by hitting that criteria? Okay.
Excellent.
All right.
Well, why don't we move a little bit off of real estate and look at a couple of the options, some of the stuff that we've done together. You sort of alluded to at the front that oil and gas has some tax advantages. Can you tell me a little bit, or tell us a little bit about what those are and how that can be used?
Sure, absolutely. So we've been talking about this active versus passive thing. Okay. And very often, if you're trying to invest in something that you're not going to spend much time on, if any, the challenge is going to be that you're not hitting that material participation criteria. And if a tax loss results, I'm not going to get to use that loss. It's going to be a passive loss. It's going to get, stuck in that passive category, and it's going to be suspended and carried over and so on. And we talked about the exceptions for real estate professionals and for the short-term rental scenario. Oil and gas is another exception that is explicitly called out in Section 469 of the tax code. And what it says is, if you own or are a part owner in a working interest of an oil and gas operation, then if you do not limit your liability in terms of structure. Okay. So what that means is I can't use an LLC, a limited liability company, or an LP, a limited partnership, to limit my personal liability with an entity. I have to own my interest in that oil and gas operation as an individual, okay, and as a general partner. All right. So if those two criteria are met, I haven't limited my liability with any kind of structuring, and it's a working interest in an oil and gas operation. And if there's a tax loss that results from that operation, I can treat that activity as non-passive. Okay. I may spend no time on this. So it's a really unique exception in the tax code where you don't have to be involved at all. You can just, if there's a fund, you plunk your investment into it, you say, great, go find oil. Okay. I'm going to go back to my work every day and do my job at Amazon. And you're literally going to spend no time on it, but you can still treat that tax loss as non-passive. And that means that you can use it to offset your wage income, interest, dividends, capital gains, whatever your sources of income consist of, you can use those to offset. Now, the reason oil and gas produces a tax loss, especially up front, is because they're going to raise a bunch of money from investors. They're going to go out and develop oil and gas wells. And the process of setting those up is basically the process where they take all the investors' money and they spend it on getting the wells set up. Okay, it takes a lot of money to get to that point where they can actually produce the oil and gas. So in that first year, they're going to incur a lot of what are called intangible drilling costs. So it's really, that's what it is. It's just the costs of getting these wells set up before they've become operational. And ordinarily, very often you're going to see that somewhere in the range of about 75 to 100% of what was invested by the investors is going to come back to them on their K1 as intangible drilling costs. So I plunked down $100,000 in the oil and gas development fund. They're going to go start setting up the wells. I get my K1, the next summer, probably. It's usually in like May or June in most cases. I get my K1 for the prior year and it says I have an $80,000 intangible drilling cost tax loss. And I can take that tax loss and I can use it to negate my other sources of income. Now think about it this way. This is especially for those of you who are in California where you might be paying 50% to income tax, federal and state. Okay. If you, if your tax rate's 50% and you got an $80,000 deduction, then your tax savings are $40,000. So you made an investment of 100, but you got 40 back in tax savings right off the top. Okay. Which means your skin in the game at that point forward is only the 60. So if you recover more than $60,000 in revenues from the oil and gas, producing revenue, then you've come out on top at that point. Okay. And you've accelerated your tax savings. You're gonna receive income from this fund, but over the course of like 2 or 3 or 4 years, that's spreading your income out into the future so that you're at lower tax brackets, but you got a great big tax benefit up front. You're also going to get what's called depletion deductions. Okay, very similar concept to like with rental real estate, where I buy a home, it's $500,000. I can break that into categories, but some of it I have to break down and depreciate. I get a deduction every year for depreciation on the home. In oil and gas, as they draw resources out of the ground, they get to take a depletion tax deduction against those revenues. It's usually 15%. So however much revenue from oil and gas sales they produce, there's also an offset of 15% for depletion deductions. So that's further limiting. You're getting more cash coming in the subsequent years, but you're still not really picking up much income tax, if any, because of those depletion offsets. So that's a lot of wealthy folks over the years. I mean, I've been doing this for a long time and kind of sitting back and watching, this is what the wealthy are doing. This is one of those things. It's not maybe the primary thing that they're doing, but they might have some real estate. They might have some stocks and bonds. They might have this or that cryptocurrency. And then they're going to have some oil and gas. And it's because of that offset. It's because they can get a tax loss and they don't have to spend any time on it.
So just to make sure everybody, I'm following and everybody else is as well, right? So I would immediately get a tax deduction, not a tax credit, but a tax deduction of 75 to 100% of my original investment, which depending on my tax rate, could be, half of that would actually be cash back. And then if I'm making money, let's say the oil well makes $100,000 in, to me in a year, then I only have to pay taxes on 85,000 of that because of the depletion allowance.
Yeah.
So I get 15,000 tax free out of that scenario, coming in, and that's indefinite, right? That doesn't stop after the first year or the second year. That's as long as I've got that working interest.
Yeah. Yeah. And be mindful that, the way they set up the sort of the future or the divestiture plan of these funds, it varies from one group to the next and from one fund to the next even. And so they might have a goal in some cases, going back many years, very common. The setup traditionally was, hey, we're putting everyone's money into getting these wells set up. Everyone's going to get their big IDC deduction up front. But after we get everything operational, it might take a couple of years to get to that point. But once the wells are up and producing, we're going to sell all those assets to a production company. And then all the investors get a capital gain, right? To the extent that everyone gets paid out because of that sale event, you get a big lump on the back end, and it's a capital gain paid to you because they're obviously selling these wells that are operational and producing for a lot more than what was put into them. Okay, so that's one scenario that could play out. The other scenario is where there's no, planned sale event on the horizon. We're just going to produce oil out of this thing until it doesn't anymore. And it might be 5, 7, 10 years that they're continuing to draw and draw and draw, and you just get royalty checks. Okay. And you're going to recover your investment over that period. How long it takes to recover your investment, it could be 2 years, could be 4 years. It's going to vary by production, of course.
Okay. Awesome. Now, something that's been in the news a lot has been the solar credits. And I know they're not as big in Seattle because Seattle, only sees sun two weeks out of the year.
Do they have rain panels? Can you put a rain panel on the house and it somehow creates energy on the rain? That'll be the next thing.
But yeah, so I want to touch on two things really. So you sort of hit on part of it, right? It's not just solar credits, right? If I had wind turbines or something like that, would they be eligible for the same sort of credits and stuff under the clean energy?
Yeah, there are miscellaneous clean energy credits available, and it's going to vary depending on the type. The most common one by far is the solar panel credits, which is 30%, which is pretty good, and with no limit on the amount. So however much your solar panel costs, you're going to get a tax credit of 30% there. There's other credits of there's one related to these I'm going to use the wrong terminology, but basically like a battery at your house to store energy. Tesla has these batteries that you can have solar panels, and then it can be charging this great big battery, and then if there's no power, you can use that. Anyway, there's credits there. Those are like $500 a piece. There's credits associated with if you buy an electric vehicle and you buy the charging stations that they hook up in your garage. There's credits there for that. There's electric vehicle tax credits, which depend on the make and model and year and where they're produced and all sorts of fun stuff there. But you might get a $7,500 tax credit for an electric vehicle. One thing I want to point out while we're kind of in the vein of tax credits is the difference between a tax credit and a tax deduction, which is very commonly misunderstood. Okay, so I'm gonna use like very basic math here because I think everyone can follow. Let's suppose that we're talking about somebody whose income is $100,000. Okay, just a square $100,000, and let's assume that person's tax rate on the 100,000 is 25%. Okay, flat tax. That's not actually how it works, but just for argument's sake here, if there was a flat tax of 25%. Then they would pay on the $100,000, $25,000 in taxes. Okay. Now, if I got, for example, a tax deduction, okay, maybe my income comes from a business, or maybe it's my Schedule A itemized deductions, whatever the case is. Let's suppose I have $10,000 in deductions. Okay, not credits, deductions. Well, how does that fit into the tax equation there? doesn't come off the $25,000 of tax. It comes off the 100. Okay. So instead of having 100 of income, now I have 90 of taxable income. My income actually went down from 100 to 90, but the 25% rate still applies. And on $90,000 of the tax percentage at $90,000, I'm going to pay 22.5. Okay. So how much did my tax go down because I got a $10,000 deduction? Didn't go down $10,000. It went down 2,500, right? 25% tax rate times the amount of the deduction is how much my tax actually went down. Okay. If on the other hand, I got a $10,000 credit, well, that doesn't come off the 100. It does come off the 25. Okay. So if I got a $10,000 tax credit, and before that, my tax would have been $25,000, my tax is now 15. So the $10,000 deduction saved me $2,500, and the $10,000 credit saved me $10,000. So it was 4 times as impactful to get a credit as it was to get a deduction. So people look at like, oh, the solar panel credits and the electric vehicle credits, not that much, they're not that significant, but there's not always comparing it apples to apples. Would you rather have a $30,000 deduction or a $10,000 tax credit? Well, I'd rather have a $10,000 tax credit, especially if my tax rates are, reasonably high. That's going to be very, very impactful. Bearing in mind that most tax credits are non-refundable, including the solar panel ones. So you have to have some tax on the table that you're going to otherwise leave with Uncle Sam. If you go and get this tax credit, they're going to reduce your tax by the amount of the credit. But if your tax was already very low or zero, you might potentially not get to use all the credit, but you can carry the balance over. So if you had, a $10,000 tax credit, and you only got to use 5 because that's how much your tax was, the other 5 of non-refundable credit is going to carry to the next year. Eventually, you're going to probably get to use it, but I always just like to point that out because it gets kind of lost in the shuffle. So there's another important point to tax planning. Let's look at your actual tax situation. Right now, what we're getting ready to do in the next couple of months with most of our clients is year-end tax planning. We're going to gather pay stubs and profit and loss statements and brokerage statements and retirement distribution statements, anything that has to do with income that you've earned in 2024 and that's going to go on your tax return. We're going to gather up as much of that data as we can. We're going to prepare a tax projection from that. We kind of hypothesize a little bit about what's the last couple of months worth of income and deductions going to look like. And we're going to say, okay, based on what we think is applicable for 2024, this is your projection. We're going to give you an actual report. And it's going to say, this is what your tax is. You either owe or you're going to expect a refund as is. But we've got 2 months left in the year. So let's look at alternative A and B and C. Okay, we create side-by-side scenarios to compare. And we say, all right, well, if you did X, I bought a property and it went into service and did cost segregation study on it, or I put solar panels up, or, I bought a new vehicle for the business, or I donated a bunch of money to charity. Let's see how that changes the tax bottom line. And then you have a couple of months left to go and implement on that before the end of the year. So, solar credits is a perfect example. You have to kind of plan that out, make sure it's going to be advantageous. You've got to look at the economics of that over the course of your ownership there, because you're going to not pay utilities or much less on utilities, but you also spent a bunch of money and you had a tax credit. So you have to kind of balance that all out and say, well, when do I see the return on my investment? Maybe it's 5 years or 7 years in or something to that effect.
Yeah, absolutely. You don't want the tax tail to wag the investment dog, but I know for me, here, energy is incredibly expensive. It's 10 times more than it was when I was in Washington State. And so my payback time, I think, was 7 or 8 years without any tax credits, and it moved it down to like 5 years, 6 years with tax credits. So basically, had a significant reduction in our payback time for the solar panels that we bought. Now, you all mentioned there's a whole bunch of different things. If I remember correctly, you can, not doing as big a deal, but if you replace your hot water heater, if you put in split AC air conditioning, if you do those sort of things in your house, there are credits available for those sorts of expenses as well, as long as they meet certain criteria. Is that true?
Yeah, there's a whole bunch of them. It could be windows, it can be furnaces, and different types of energy efficient air appliances and things. The credits are limited to much smaller amounts. So, you know, you might have, for example, a heat pump category where it's limited to $1,200, or you know, insulation that's limited to, I think, $300 or $500 or something like that. But, you know, if those are things that you're thinking about, then it's worth, you know, checking if there is a tax credit available. And of course, you're also going to come away with energy efficiency in your home. So it can be kind of a double whammy. Even some of the utility companies, like here in the Phoenix area, there's a couple of them, but, you know, SRP is one. They offer some rebates for smart, you know, energy types of home improvements that you can do, even to, like, you know, putting dark screens on the windows and things like that, where, you know, if nothing else, it subsidizes the cost of doing those things and then makes your house more energy efficient. So, you know, look into those things. Again, sit down with your CPA if you're looking at doing some renovations or home improvements, especially in the energy efficiency categories, and see what's available, because it does help subsidize the cost on those things.
Awesome. So I'm gonna, you know, I don't see any questions in the chat yet, so I'm gonna keep asking you questions because I've got enough to more than fill an hour. But if anybody has any questions that they'd like to ask, feel free to put them in the chat, or it's a small enough group, you can even just, you know, raise your hand and unmute at that point. But so, self-serving question. You mentioned that when your rental property moves off of your taxes, it frees up all of the losses. What would happen, you know, and obviously selling the property is the most likely way for that to happen. What would happen if you, let's say, moved into a rental property and it became your primary residence? Would that free up losses, or would those losses stay in the passive category indefinitely?
Yeah, in that scenario, the losses would stay in the passive category, and probably what would you know, result in them being used if you know, you sort of kept living in that house indefinitely, is that it would be held until you had passive income from something else. Okay, and the difference there is that you still own and have the asset. It's got all the value that it had before, so it doesn't really count as a disposition. Disposition is almost always going to be either a sale or some kind of a bankruptcy or a liquidation, where, you know, where it just doesn't exist anymore for you at that point.
Okay. All right. So we got some questions. Excellent.
All you had to do was ask.
Yeah. All right. So let's start with BIN use. For multifamily syndication, how does that change your taxes? Because it does.
Yeah. Well, it definitely depends on what your involvement's going to be. If you're investing passively, then, you know, probably the vast majority of individuals who invest in syndications passively just own their interest in the fund individually. You can own it through a trust, or you can own it through an LLC, but tax-wise, it's going to be the same outcome. You already have some built-in liability protection because the fund itself is an LLC partnership in most cases. So the individual owners have liability protection from that entity type as it is. The partnership is liable for its own liabilities, not the individuals. But I do see a lot of folks who set up like a real estate holding company LLC, and especially if you have a lot of K1s. So I've got some clients that have 40, 60, 80 K1s that come from all the different funds they're invested in. And they may set up an LLC partnership where it's husband and spouse, spouses owning the LLC partnership together. The LLC receives all those K1s on their behalf. It files a partnership tax return instead of all those K1s hitting your individual tax return. They hit this partnership business filing instead. And the advantages there are, from an audit perspective, number one, entities are along the lines of 5 times less likely to be audited than are your personal tax returns. So if you can take a lot of that noise of all the different investments and activities that's on your personal return and put it over here on a partnership tax return, that is seen to improve your audit protection. But then it also does add another layer of liability protection because it's another LLC. And as far as tax deductions go, you may find that presenting those deductions, if they're sort of miscellaneous in nature, that putting those on that partnership filing is a better fit than having them on your personal filing. If on the other hand, you're going to be active in these syndications, and especially if you're in the GP group on one of these deals, you need additional structuring. Okay, it's going to become a little bit more involved because you're going to have probably a couple of different categories of income now. You're going to have some passive income because of the LP side of if you actually put money in the deal. But as a GP, you're going to usually have some active income. You may have a fee for assets under management. You may have a promote fee or acquisition fee on the front end. And because you're involved in the GP side of the business legally, you want to take an extra measure to protect yourself from liability. Because if anything goes wrong at the fund level, they all point to the GP group. Hey, you guys screwed up and now I'm coming after you. So then you probably have a couple of different avenues in your structure where, anything passive goes up this avenue to ultimately hit you, and the active stuff in your GP role goes up this other avenue of your structure. And, depending on the magnitude of the income on the active side, you may have an S corp to mitigate FICA tax. So it depends. You definitely, it can be more involved. Passive, relatively simple, potentially. Active, a little bit more involved, some more structuring probably that you should do there. Definitely want to meet with your CPA and your attorney about that.
Okay. So let's see. One of the questions was, can you offset stock gains with real estate losses? You talked about your active income. Stock income is a little bit different.
Yeah, stock income is ordinarily passive. You're going to have short-term gains or long-term gains, and the tax rate might be different between those two. Short-term gains are ordinary income as far as the tax rate that applies, and long-term gains have a lower tax rate, 15 or 20%. But that's still, you still have to look at whether it's active or passive. Okay, and both short and long-term gains are going to be default. I hate to call them active because they're not really active, but it's not a passive activity.
I've heard it called portfolio.
Yeah, I call it portfolio as well. Interest, dividends, capital gains is portfolio. And even though that's not active in the sense of like a W-2 job, it's also not passive either. So you can't take passive losses from real estate and then use those to offset portfolio income in the categories of interest, dividends, and capital gains. The only exception there, no, I'm not even going to go down that road. I was going to talk about you can be what's called a day trader, or if you have trader status, then you have sort of like an active business as a stock trader. Doesn't apply to a lot of folks, but if it does, then there's some planning around that to do. But that's probably a conversation for another time.
Okay. Sounds good. So
go Ducks. I got to congratulate the Ducks. They've had, they're obviously exceptional. So congratulations to all the Duck fans out there. You got to give credit where credit's due. All right.
All right. A question I hear a lot from investors is loss of monthly rental income because of vacancy considered to be a passive income loss.
No, in fact, it's not a tax loss at all. So this question comes up all the time. Yep. I would have had this income, but then I didn't collect the rent because, the tenant, whatever, and then I had to evict them or whatever. So can I deduct a loss of the income that I was going to collect and didn't collect? And the answer is almost always no. The only exception would be if you have a rental business, whether it's residential or commercial, where you are on the accrual basis of accounting. Okay, remember this, this is accounting 101, cash versus accrual. On the cash side, I only recognize income when I got paid. So whatever the rents I actually got, that's what's going on my taxes for income. If I didn't get paid, it's not income. All right. On the accrual side, you recognize income based on the passage of time. If I had a lease with a tenant and they were supposed to pay, as that time passed, I am going to accrue and recognize income because I earned the rent. I haven't been paid yet, but I earned it. So that's a scenario where you can have a timing difference from one period to the next. I might accrue revenue in Q4 for rents that I was supposed to receive, and I might pay tax on that revenue. But if in Q1 or Q2, that tenant's evicted and I realize that I'm never going to collect those due rents, then I have what's called a bad debt loss. Okay, I can write off the bad debt in the next period when I've sort of determined it's never going to get paid. At the end of the day, that's a timing difference. So in scenario one, I only recognized what I received as payments. That's my income. And in scenario two, I sort of accrued revenue and then I had a loss, and those two wash out. It's the same amount of income. At the end of the day, what you're going to report as your income is only what you got paid. And you don't get to add to that a loss for sort of hypothetical unpaid rents.
Yeah. And then a very general question is buying commercial properties beneficial for taxes? And
yeah, absolutely. Yeah, and commercial can mean, depending on, if you're talking in the lending realm, even a residential property with more than 4 units is considered commercial on the lending side. But tax-wise, the question of residential versus commercial is, how's the property being used? It could be a single-family home or a 1,000-unit apartment complex. If people are living in it, it's residential. So the tax benefits can be just as good on either side, because in either case, you can buy a property, whether residential or commercial. You can obtain a cost segregation study where they say, okay, of what I paid for this property, this much is land, this much is land improvements, this much is furniture and fixtures, this much is building systems, and this much is just the building itself. Well, a bunch of that stuff I can accelerate and take big depreciation deductions up front if I get a cost segregation study. That's true for both residential and commercial.
Okay. Got just a few minutes, so we'll try and hit these pretty quick. What can trigger a tax loss when renting real estate? Mostly depreciation or anything else beyond depreciation?
Yeah, the biggest thing overwhelmingly, especially in the first year, is going to be depreciation deductions. And again, with that cost segregation study where I get to sort of splice that property up into categories and say, oh, these pieces can be accelerated, and I get to accelerate the depreciation, take big tax deductions up front. That's the biggest thing. But really, if you look at what reports on your tax return, it's rents at the top, and it's all the expenses associated with the property: management fees, interest, insurance, repairs and maintenance, property taxes. If you have to pay to do renovations or repairs, if you have to buy furnishings, all of the costs that you incur as part of owning and operating that property, those are your deductions. Depreciation is just one of those many. So the more deductions you have, the bigger your tax loss is going to be. And so you can talk with your tax planner and say, hey, how do we drum up some more deductions on this thing? Maybe we talk about home office deduction or business use of your vehicle, things like that, to maximize those deductions.
Awesome. Is there a difference from the tax perspective between buying less than 4 units or more than 4 units?
No, it's really just about how much time you spend on them and whether the cost versus savings potential is there on things like cost segregation studies. So you have the same potential tax deductions, the same potential tax rates. It's just a different scale is going to apply, and potentially different lending terms, again, because you might be going into the commercial lending space above 4 units. But from a sort of foundational tax perspective, no, there's really no difference.
Okay. Sarah's asking about short-term rentals. If you have a short-term rental that you participate in and take sort of the easy way out with the 100-hour qualification, but also engage a property management can you also engage a property management company to handle some of the tasks while still getting that active deduction?
Yeah, absolutely, you can. And so the question becomes, if there's a management company and they're really shouldering a lot of the burden of running the thing, will you still have 100 hours on the of involvement with that activity over the course of the year? Very often you still will. And so if that's the case, then yeah, you can still treat that as a non-passive activity.
Awesome. And then I love the way Tim's thinking for the last question here. So if you have a business and you put your kids on payroll to your rental real estate companies, both over and under 18 years of age, is it better to add to payroll or pay them as a contractor out of a family managed LLC?
Yeah, this question comes up a lot too, and what a lot of folks, and to be quite frank, some misguided accountants out there sometimes misunderstand this one too. The thought process is, well, there's a standard deduction, right? And the standard deduction is whatever it is, it's $15,000 or $16,000 per person. And if so and so my child earns under the standard deduction, then they're not going to owe or even have to file any tax returns. So does it matter whether it's 1099 or W-2? And the answer is yes, it does matter, because there are two different categories of filing thresholds there. Wages falls into that sort of standard deduction category. That's the sweet spot. If I have wages under the standard deduction, I'm good to go. I don't have to file a tax return, and my tax is going to be zero. 1099 income is a different kind of income. It's self-employed income, and there are self-employment taxes that apply to that income. And the filing threshold's not $13,000, $14,000 standard deduction. It's $400. If you make $400 or more on a 1099, you have a tax filing requirement. And even though your regular income tax is going to be zero, you are going to owe FICA tax. You're going to owe self-employment tax on that. So if your goal is to not have them file a tax return and to not have to pay any tax, paying them on payroll as a W-2 employee of your company is the way to go. And if it's rental real estate, very often you have a scenario where even if it's an LLC single member or a partnership LLC with spouses owning it, if they're minors, they are exempt from FICA tax, even though they're on W-2. So if they're 17 or under, you pay them out of a family-owned LLC, single member or partnership LLC, where it's just your family, you individually or you and your spouse, and they're minors, you pay them as employees of that business, they are exempt from FICA tax. So they have no income tax and no FICA tax. Income goes from your high bracket to their low bracket, zero, right? Then they can contribute to a Roth even, all sorts of fun stuff you can do there. But it's got to be W-2.
Awesome. I think that's a great one to end on. Really appreciate your time, Jim. Thank you very much. It's been highly educational. I hope everybody else believes so as well.
Yeah, thank you so much, Terrence. I'm happy to participate, and I saw a handful of familiar names. I know some of my clients were on the list, and some of your contacts as well. So if anyone needs assistance with anything, hit up provisionwealth.com or look me up on LinkedIn, Jim Ross CPA, and let's have an introductory conversation and see what we can do to help you out.
All right, awesome. Thank you, sir. Appreciate it.
Hey, thanks. Take care.
Bye.
Bye.